Hello and welcome to Livewire's Buy, Hold, Sell. I'm Tom Stelzer. It's AFL Grand Final week, so we're taking a look at the growth stocks that are making their mark and kicking goals right now, whether that's on revenue, market share or margin. To analyse the key players, I'm joined by Tim Riordan from Blackwattle and Brenton Saunders from Pendal. Guys, thanks for joining me.
Thank you.
We're going to start with a bit of a bang. Explosives company Orica. Tim, I'll go to you first. Is that a buy, hold or sell?
Orica, we're a sell. Look, it's one we keep a pretty close eye on in terms of the sort of basket of industrial cyclical businesses out there. It's one that we tended to struggle with from a quality perspective, which is the way we think about things at Blackwattle. It tends to miss the mark just in terms of the relative earnings, returns, cash generation. And so there's a few other businesses in the mix that just tend to come out on top when we compare the basket. So what's in behind that we struggle with is really around the sort of, on one level, the concentration from a customer perspective. Puts a lot of pressure on Orica in terms of their pricing power. They don't have a lot in terms of product differentiation to really push. And then on the cost side, there's not a lot they can do with some concentration in terms of inputs, particularly gas. And so, if you look at the last several years, sort of since COVID, they've done quite well to recover, but they're really only back to a peak in terms of EPS where they were 6 or 8 years ago. And all that time, the business hasn't really gone anywhere in terms of price performance. It's lagged the market a little bit. It has been doing better the last 6 months. So again, keep an eye on it, but for us, it's a sell.
Brendan, same question to you. Buy, hold or sell?
We're a hold, but we have been a buy for a while now. It's done well recently. I mean, the things we like about this company is it's got a much improved management team that's been put together over the last 3 or 4 years. It's just had a big step up and improvement in the board. Vic Bansal from SGH and Cleanaway Foam joins the board as the new chairman. We think that's a very handy addition to the business. And then I'd have to differ with Tim a little on some of the product differentiation. I mean, it's been a big push for them both to diversify the company and to differentiate some of their core product over the last 3 or 4 years. And that's really starting to show up now tangibly in earnings for the first time. The other thing we really like about it is the alignment and incentive structure for management is very, very simple, very transparent and very aligned with shareholders, and that combination with the new CEO we think is a very useful addition.
Next name on the team sheet is location tracking and safety app Life360. Brendan, I'll come back to you. Buy, hold or sell?
Yeah, I'm a buy on this one. I use it personally. I have done for a very long time. The thing we like about this one and with growth stocks like this one is very big market to tap into. They have reached a point now where they're pretty much self-funding, and that's a really important inflection for growth stocks, I feel. And they have multiple revenue sources. It's not just subscriptions from the app. They have advertising revenue now as well. A very capable management team, and we like it when growth companies just have a big market and all we have to focus on is their ability to execute and benchmark management against their own milestones. It makes our jobs easier.
Tim, it's been one of the big growth stories on the ASX, but are you a buy, hold, sell?
Yeah, we're a buy as well. So echo quite a few of Brenton's points there. I think the things that we look for from a business model perspective through the quality lens is really trying to understand where these types of businesses have their sort of special sauce. What stands out from, to build on what Brenton was talking about in terms of the scale that the business is at, is sort of getting close to 100 million users globally. Half of those are in the US. But from a penetration perspective, they're still only sort of 15% penetrated in the US, using that as an example. There's multiple different structures that they've got in terms of pricing. And one of the key pillars from a business model perspective that we've really found really attractive with 360 is the enormous free user base. So, free users, that's great, doesn't contribute to the bottom line, but what it does do, because of the virality of the business model, my family are all drawn into using the app through referral and then through our friends and their families, etc. When it comes time to actually convert those users to paid users, which a small subset of the free users do at some sort of life stage, Often when your kids start driving or have a mobile phone and start sort of having some more freedom, what happens at that point with this enormous free user base is the business can convert those users to paid users at a very, very low cost, often just by email and being in touch with us via our mobiles. Yeah, that's distinctly different to many technology businesses. And so the advantage that 360 have, and that's now turning up in the margins, is the benefit to margins is immediate. And so that's a hugely attractive dynamic, one that's quite unusual as we look through listed software peers. So that's one of the other key points that's got us attracted to the business. The outworking of that from a scale perspective is that the opportunity that the business has to continue to grow is really enduring. So again, from a quality perspective, it's come out of this sort of small and early mid-cap stage. It's just arriving on the scene as a really high quality, top quartile, enduring quality business. And from that perspective, we think it's a buy and it could go a long way.
Another big growth story has been investment management platform Hub24. Tim, I'll stay with you. Is that a buy, hold or sell?
Hub's a hold for us. A very high quality business and one which is, together with Netwealth, winning the vast bulk of flows in platform land. It's benefited with a really innovative approach to product development, and it's also compounded those gains by having a real will to win. They've been willing to sort of scrap and fight to win flow, and they've done incredibly well off the back of that. So look, we're enamoured by the position that the business is in. We think it can continue to grow, and it's one that compounds really nicely. The challenge we've got at sort of 70 plus PE and a PEG of 3-ish is that we struggle to differentiate up here. And look, comparing it to a few other businesses in a similar space, we feel like we've got a few alternatives, so we'll stick with a hold.
Brenton, same to you. Hub24, buy, hold or sell?
Yeah, I like this one. We're a buy on this one. For me, the proof is really in the eating. A lot of my clients use this platform. By and large, they're enamored by it. It is a disruptor. It is an enabler. It is positioned in a thematic that is not only the growth of defined contribution superannuation in Australia, which is probably the biggest gift to the market that the Australian market has, but it definitely is a way better product than all of the incumbents. And most of the incumbents still to date find themselves in a position where they're pretty disorganized. Lack of good incentive structures and management structures has left the door wide open for the likes of Hub. So they continue to take share in a market that's grown not just through market growth, but through ongoing superannuation contributions. Valuation is always probably the main question around this one, but it's pretty hard to fault the dynamic. Again, a very big addressable market, low levels of penetration so far, good execution, and by all accounts, a very good product.
And for this part of the show, we've asked our guests to bring a growth stock of their own that they think can continue to kick goals over the next 12 months. Brennan, I might come back to you. What have you got for us?
So we've got Zip. So we really like this one. So this is a buy now, pay later business that is principally located in Australia and the US. And some of the reasons we like it are, it generically ticks a bunch of boxes for us for growth stocks. But one of the reasons it really appealed to me was because there was so much baggage with the stock. It started out in life in a very different frame, grew very quickly, outgrew itself, had to shrink the business, get recapitalized, almost went under, complete clean out of management, and a very different strategy to the one they had that people think back on. The new strategy is a stable or modestly growing Australian business and a very fast growing US business. The nice thing about the US business is very capital light. They turn their capital over really quickly. It's very profitable for them now. Buy now, pay later as a construct in the US is still heavily underpenetrated relative to other OECD markets. And within the context of buy now, pay later in the US, they have quite a niche in terms of the subgroup of the population that they bank and appeal to, where there isn't a lot of overlap with some of the bulge bracket, big buy now, pay later users. And it's not that discretionary in terms of spend. A lot of it is is non-discretionary spend, where people that can't get credit cards are using this as a route to pay their car insurance, buy groceries, and just do normal day-to-day things as opposed to running out and buying highly discretionary items. The risk is also being managed, the credit risk is also being managed in a much tighter band, and it's self-funding now. So that's another big box ticked for us for growth stocks.
Fair enough. So that's it from Brenton. Tim, what have you got for us?
We've got Seek. So Seek's one that we've sort of warmed back to over the last 12 and particularly the last 6 months. The backstory, I guess, with Seek is that it's easily the most cyclical of the Aussie classifieds businesses. It's gone through a really tricky sort of 2-3 years, partly investment related and partly sort of cycle related. So they've put up with a really, really large headwind from a classified volumes perspective. But what's been interesting all the while is that they've been able to continue to demonstrate really solid pricing power. I mentioned that investment program, and what's actually come out the back of that as it's rolled off is a structure from a technological perspective that enables the business to roll out their technology here in Australia and to their businesses in Asia far more quickly, something that the likes of car sales had done many years ago, and Seek is really now just catching up. What's attracted us to the business is that the valuation had got back to a far more reasonable level. A couple of years of hard times and large investment had seen investors sort of pretty skittish on the name. Quite a few downgrades had come through up until sort of mid to late last year. And so then it's not a loved business. And we don't think even now after the business has started to perform a little bit better over the last 6 months that's the case yet. It still trades on a really favourable sort of mid-teens EBITDA multiple if we take the valuation of the Seek Growth Fund out. That's another layer that we find is actually at an interesting juncture. Probably another series to go into to talk about the establishment of the Growth Fund, but it is what it is. Seek own about 80% of circa $2 billion worth of investments. There's an opportunity for them to realise some value from that over the next 12-24 months. And we think that's likely to layer on top of Seek starting to demonstrate a better cadence in terms of top line growth, some margin expansion, and some really solid cash generation. And so from that perspective, we're really excited about Seek's prospects over the next few years.
That's all we have time for today. Thanks for tuning in. Make sure to check out our YouTube channel for more buy, hold, sell.